For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. We are managing your financial future, and welcome back. Another episode. I'm very happy to be here. I love podcast time. It's my favorite time of the week, just because I get to do the things. I get to talk, and I get to talk with Professor Plum or other advisors that are smart. We had a discussion about this off the air, and I won't get into it.
Yeah, we better not.
We won't get into it. But let's see. As far as knowledge goes about financial planning, I can say with certainty, and you can too, Professor Plum, that the folks at Lucia Capital Group, can I say they know more than they've got a higher standard? Let's put it that way.
We do put education for our advisors and knowing a lot about financial planning at the forefront of everything we do.
Yes. And just based on some recommendations from other
that we've seen recently,
it just blows my. I don't know. It blows my mind. I don't want to get into it. I really don't. I'm not here to slam.
By the way, those recommendations were not from a Lucia Capital Group advisor. They were from an outside advisor.
An outside advisor, and you were looking at this, and I was looking at this, and I said, well, now what in the heck? How would this advisor not know that? Okay, that's neither here nor there. We were just talking about knowledge. The folks here at Lucia Capital Group have just a tremendous amount. Can I say that?
And it also helps that we work on a team approach where each individual advisor doesn't have to know 100% of everything.
Yes.
They just have to know that so-and-so knows 100% on that topic.
Yes.
And this person over here is really good at this topic.
So let's do a team.
We do a team approach.
Just before we turned on our mics, you had a phone call from somebody who wanted to confirm something
right.
about, income and all this other stuff and pensions and all that. So, but they said, I think they were meeting with somebody, and they said, let me just confirm with Professor Plum. I think I got it.
Yeah.
They called you. You said, yeah, that's correct. And you gave them a little more detail. Perfect.
Yep.
One and done. All right. That has nothing to do with today's episode. But, when things happen, it is fun. And that's what I enjoy about this. When things happen right before the microphones go on, I feel like I need to talk about it.
Yeah, I actually thought it was annoying you because just as you're ready to hit
we've
done our mic check. He goes to hit the button.
And there's the phone.
My phone is like, hey, I got to take this.
Sorry, got to take this. Anyway, all right. So we we talked last week. This is kind of like a continuation. It's like a continuation. It's not a part 2, but it is a continuation of our discussion last week. I hope you heard last week's. If you didn't, you may want to go back and check it out. Last week we talked about how much you're going to need to retire. I hope they put these episodes in order, by the way, because they're not released for like 2 weeks after we do them. How much will you need to retire? How do you know if you can retire, and what assumptions you make?
And last week, either the good thing or bad thing, depending on how you want to look at it, we didn't actually get into the math of how to do it, which some people would say, thank you, and others are like, but I need the math.
Well, we could mention a little bit of that today, but what we did talk about was understanding how much you need to spend,
right?
And then deciding
where your income is coming from,
and how to calculate how much.
Yeah, figuring out your shortfall, not just in the first year of retirement, but going forward in case things change and things like that. So understanding the distribution that's required, assuming you're going to require a distribution, that you're not just flush with pensions and Social Security. But what the distribution from your portfolio is going to be over a series of years.
Yes. Now, we also talked about the impact of taxes. How do taxes
That's an expense.
affect? And it's something that you need to keep in mind. And when I talk about taxes, we're talking about taxes potentially on Social Security. When you look at the amount of money that your Social Security is projected to provide for you,
right,
that number needs to be reduced by probably by the Medicare premium or premiums, depending on which ones you elect, right? But you're going to have a Part B if you're
it's either Part B or C,
right?
And then some others depending on which way you go.
Correct. So that number may not be correct, and then if you have other income, your Social Security may wind up being taxed. So that number could be a lot less. Now, the last thing that we talked about was the X factor, which had to do with longevity.
Yes.
And how long, I would assume you don't know how long you're going to live. You can make a reasonable guess, but you're probably going to be wrong.
I'm hoping you don't know when you're going to die.
Yeah. I mean, you could say I'm going to live a long time, and you may be correct, but you can't say I'm going to be done at 90.
And for the people that say, well, I'm average, 82, 83, whatever it takes, I would say that's fine, but plan on longer just in case. Because, the old adage of, I want my last check, the check that my estate writes to the undertaker, I want it to bounce.
I always wondered how undertakers felt about that,
Yes.
This is my fifth bounce check. What's wrong with you guys at Lucia? This is my fifth bounce check, And
I say, well, you can create a plan, a distribution plan to do exactly that. If you give me one little piece of information.
How long are you going to live?
The day that check is going to be written.
Well, and hopefully you don't have heirs. Planning is more than that.
Right.
Of
Most
course.
people do want to leave something for their heirs as well. But that's the old joke of, I want that last check to bounce.
Right. And that,
I want to spend everything in my lifetime.
And that means you made it last. Correct. But the last thing, when we were talking about longevity, I brought up a question about buckets. And I said, do buckets... I didn't want to. I wanted to word this correctly, but I wanted to say, does a bucket strategy, when done correctly, in theory, could it provide for could it take away the longevity risk? In other words, of living too long.
In theory, almost anything, if you do with certain assumptions, it depends on the assumption. We talked about this. Buckets will not cure an overspending. It doesn't. If you're spending 8, 9, 10% a year out of your portfolio, buckets isn't going to make that last for 100 years. But what I was looking at is buckets can help you not screw things up quite as much. But you have to understand time horizons. You have to understand why you're doing buckets. What is the concept behind buckets compared to the balanced approach or just the one portfolio type asset allocation model?
Yes.
I mean, technically, buckets is a decision of how to allocate your portfolio. Just like a balanced portfolio is, how do you allocate your portfolio? This much stock, this much bond, this much cash, or whatever else you're using. The difference is one of them gets rebalanced every year and one of them doesn't. And one of them takes a little bit more management and it takes a little bit more thought. And you have to then, what the buckets will help you do is not have to sell something when the market is down, because you've allocated money to safer areas, bucket number one, so that you can draw down a safer, less volatile, maybe using treasuries right now, pretty unvolatile as far as principles are concerned, so that if the market does go down, or I shouldn't say if, when the market does go down, we just never know when it's going to go down, you're not selling assets when the market is down to create the cash flow that you want today.
Yeah, and
that's the concept. You never want to be put in a position that you're selling something that's in a negative position. Which
begs the question naturally, and this came from another listener of ours a week or two ago on an email, which was, how much of my portfolio do you believe should be in stocks when I retire? And that's kind of what we ended the episode last week on. And of course, the generic blanket answer was, it depends. But I don't want to leave people on an it depends answer. I want to kind of get into for a bit here how you determine this for somebody, because there is something that we've talked about before, which has to do with the rule of 100. And I hate that. It's not a rule. It's not even a guideline. Frankly,
it's a kind of a dumb thing, really.
How does that go?
Well, the idea is you take the number 100, you subtract your age, and the result is how much money you should have in stocks. I've heard it both ways, though. That's how much money you should have in bonds too. But so if I'm 65, 100 minus 65, 35, should have 35% of my money in stocks,
and 65%
in bonds. But that's what they're saying.
And then the older you get, the more you should.
Yeah, 100 minus 90, I have 10% in stocks and 90% in bonds. 90% safety.
Why is that dumb, Professor Plum?
Well, that assumes that every 65-year-old has the same goal of their portfolio, has the same distribution pattern from their portfolio, has the same risk tolerance from their portfolio, has the same income from other sources, that everybody is just every 65, every 66, pick your age. Everybody should have the exact same portfolio at the exact same time in their life.
Well, which is a problem with rules of thumb to begin with, for the most part. But if somebody's following that, Doesn't that encourage somebody to sell the stocks as they get older so they can decrease their allocation and increase their non-volatile assets?
It also goes under the presumption that as you get older, you should have less in stocks. You can't afford the volatility as you get older. And the reality is not exactly true. Who can afford more volatility, a 65-year-old or a 95-year-old? And the answer is the 95-year-old actually can have more volatility. That 65-year-old is going to need to fund a 30 to 40-year distribution. The 95-year-old does not need to fund a 40-year distribution. At least, so far, we've never had anybody make it that far.
At least based on history.
Yeah.
The human evolution, right?
Right. And
even if you did, how much are you spending at that point?
So that is purely an emotional issue that a 90-year-old can't afford volatility. They should not have 50% of their portfolio in stocks. And
that's what they're saying.
Or more. When the reality is the 90-year-old, the majority of their portfolio that's left, they're never going to spend. That's for the heirs, whether it's the kids. The kids are 70 at that point.
If you're 95, there's a good chance that the kids are 70.
Or for the grandkids. Yeah. And how would those individuals, the beneficiaries, be investing those monies? Would they be investing it in bank accounts, CDs? Or would they be investing in hopefully to get some growth? Sure, grandma may only live another 3, 4, 5 years. But the time horizon for that asset to be spent isn't 3 or 4 or 5 years, unless you know that the beneficiary is going to cash it out and spend it a lump sum, all lock, stock, and barrel in the first year.
Well,
so we're looking at how do we invest for the expected time horizon of spending that asset.
This came up in last week's episode as well, which is why this is a good part 2. We talked about a mistake it would be to have somebody who is 2 years, 1 year out from retirement, and they've still got 100% in aggressive growth stocks. That's their entire portfolio is made up of these volatile, aggressive growth stocks, which when the day they retire is worth $1 million, but then because the market drops 6 months later, it's down to $800,000. That is somebody,
and that's wrong if the person needs to take distributions from the portfolio.
Well, correct, but I'm saying if that's all they have, if their entire portfolio is stock. What you were saying was that would have been a mistake, because as you approach retirement, it's probably a good idea to pair off some of those stocks. But now, as you go through retirement from, say, age 65 and try to make it to 95, Professor Plum, is the opposite supposed to happen? Are you supposed to, at that point, should your portfolio then be greater allocated as the years go on to stocks?
It can be. Should it be? That depends on risk temperament, attitude, emotions, and other things. But it can be a little bit higher allocation to stocks because of the fact that we don't need to support as long of a distribution as we did. The day you retire is the longest distribution pattern that you're going to have. By definition, the longer you live, at some point there's a finite date out there.
There's a wall out there, and you're going to hit it. Yeah.
But it's a matter of allocate. And one of the nice things that doing a buckets plan can do for you is you had the question, how much should you have allocated to stocks? A properly allocated buckets plan will specify how much you can afford to have allocated to stocks, because you're setting up bucket number 1, bucket 2, bucket 3, bucket 3 being the long-term growth bucket.
That's your stock bucket there.
We know that you have enough money to distribute over the next X number of years that doesn't have the volatility. And we know we've got at least pick your X, 12, 14, 15-year time horizon for the stock market investments. We've identified that you can afford to put this much money. If you've got a very high distribution rate, your percentage of stocks is going to be lower. If you've got a very low distribution rate, the percentage of stocks that you can have invested for long-term growth is a higher percentage.
Because you don't have to touch them.
Right.
You shouldn't touch them.
You don't need to touch them for 15, 20 years. And over that 15, 20-year period of time, even though the market will go down at some point, and even if it goes down the day after you do this, which Murphy's Law says will happen, doesn't matter. You got time for it to recover and time for it to do better than what you could have done by keeping it safe.
Well, okay, an element of just use the words that the listeners can use, the words that we're trying to put in their head.
but there is
potential.
There is value to not having to worry quite as much.
Well, now if you look at strictly at a bucket strategy, the way it's designed at its most basic form, without doing any value averaging or anything like that. I mean, a bucket strategy is designed where if you had $1 million, you might put 300,000 in safety.
Yeah, it might be 300, 300, 400. Just
right. Let's just say
up.
300, 300, 400.
Typical.
And let's say you go through the first 15 years spending down bucket one, and you go through the first 7 years spending bucket one. You spend down bucket number two over the next 7, 8 years. I mean, by definition, your
percentage of stocks is going up.
Your ratio of stock to non-stock or volatile to non-volatile is going up just by pure definition of a bucket
because you are
strategy.
Spending your safe money first. And as you spend down, you have less of the safe money. You're hopefully growing. The potential for growth is in the long-term growth area. So if it does what it's always done in history, which is over 10, 15 years, grow, that side's getting bigger, the safe side's getting smaller. So as a percentage, your growth assets are becoming a larger percent. But that's why we also do value averaging and other things.
You would certainly do that.
That's why you have to do continued management oversight and see what's going on. We do. In just a typical buckets strategy, you're looking to take advantage of the market. We've set up the buckets to protect you from a downturn in the early years so that you have your distributions available from a source that's not affected by a downturn in the market. But that doesn't mean that the market's always going to be negative. In fact, most of the time the markets do well. And so the idea is to look for opportunities where the market did better than expected.
And then dump that in.
Then value average. Pull some of the cream off the top and reset your buckets to another longer period of time.
And give you another year maybe.
Who knows
whatever
how much.
It is.
I mean, we had, the late part of 2020, 2021, those were way better than expected years. If you expect the historical average of 9%, 10% in the stock market, 2020 was, I think, over 20%. 2021 was closer to 30% returns in the stock market. That's when we look to pull money off the table and refill bucket number one, so that when we go through a year like 2022, and who knows what 2023 will end up looking like,
you have what they call dry powder.
Yes, and you have your buckets in place. So it's just a matter of but the idea is, in all of these scenarios, we're identifying how much stock or how much risk you can take.
Is a common ratio of stocks when somebody retires. You just mentioned this. You got $1 million, quick, easy thing. Is it common to have maybe 40-ish% in stocks?
It's not uncommon. Yeah, anywhere from 35 to 40, maybe more.
Yeah, that may be
again depending upon how much you're going to distribute. Now, some people have a higher distribution rate at retirement than they will 5, 6, 10 years from now, because they're expecting to travel more in the first 5 or 6 years while they're healthy. So they're expecting to pay for grandkids' education. There in some cases we have a little bit higher distribution rate, which would then require more money in bucket number one, less money in bucket number three. So
you would have a lower, potentially in that situation, lower allocation to stock. You would have higher,
because you have higher spending needs early, less spending needs late.
If, on the other hand, to repeat kind of what you said a few minutes ago, if on the other hand you are your income needs are maybe set with just between Social Security
and
pensions,
we have met those people,
and you can allocate a much higher percentage to stocks, or what? How does that work?
I've met people whose pensions and or Social Security, the combination, a lot of times it's pension only because they're firefighters. They're other, and their pensions are very healthy in many respects. They've got more money coming in from pensions and Social Security than they spend, including taxes. They're actually continuing to save in retirement.
So they don't even need the money in their portfolio.
So whatever they've built up in their 457s, their 401ks, their IRAs, they really don't necessarily. These are the people that don't like RMDs, because what am I going to do with this dang stuff? I mean, but they can invest their portfolio any way they want, because it's not going to affect their current lifestyle.
So in other words, they aren't even necessarily, they have their bucket one covered.
They are, their pensions are buckets 1, 2, and 3. The pension is the money they're going to spend in the next 6 to 7 years. And it covers all their expenses that they need from the 8 years to 15 years. And it covers all their expenses from year 15 on because it has a cost of living adjustment on it as well. So they, except for some crazy, who knows what, that they might need to dip into their, they really don't need their portfolio.
Yeah, so
they're investing it for heirs.
To answer that question then, that's why we said it depends. If you're asking the question, how much of my portfolio should be in stocks when I retire? The it depends part is what we just talked about.
It's based on your distribution needs.
Yes, if you need to take a higher than normal distribution,
less money in stocks.
There's a limit. You can't have for too long 10, 12, 14, 15, 20%.
Well, sometimes that's what people will do. And they say, you know what? I understand that this is going to last 12 years ish, and then it's going to be gone. But right now, there's nothing I can do about it.
In which case, would you have probably a very low allocation?
Very low allocation
to
bucket
stocks.
3, the stocks.
But we've seen, I'm sure, and it's out there, people who just leave all their money in stocks, and they're going to take a 12, 15% distribution, and they say, well, I'll just sell stock as I need it. And
right, which is dangerous because you're more likely to run shorter on that than extend, even though the potential rate of return is high. The volatility is very high. And when the volatility happens to be on the negative side, you have to sell a lot of shares to get the same cash flow that you would have gotten the year before, and that's what you wanted. And so those monies can never come back to try to get you back to an average rate of return on the stock market. There was a very popular manager in the 70s who wrote a book about distribution, or part of his distribution was, well, the market averages 8, 9, 10%. You can stay fully invested in the market, take out 4%, have 4% left over for inflation, and you'll be fine.
No.
And then he had to recant that a couple of years later when he realized, well, that's one of the stupider things that we can talk about, because you don't get 7, 8, 9% each and every year out of a stock return. Over time, you average, if you look at, depending upon which 10, 15, 20-year period, well, I shouldn't say 10 because we've had 10-year periods of time where it earned nothing.
Well, would you say that selling stocks as you need them is less of a problem when you're much older than it is in the early part of retirement?
I don't like selling stocks when they're down, regardless of what age you are.
Yeah.
And so I don't, that's just something that I don't want to do. I don't ever want to be put in a position where I have to sell stocks.
But to do so,
I have to have money on the sidelines.
To do so, doesn't it causes more damage early in retirement?
Well, if the sequence, if you're,
I want to get it just very quickly talk about
if you're planning on selling assets to create the cash flow that you need, and the cash flow is relatively steady, so you need about the same amount every year, and you're just planning on selling assets, whether it be out of a balanced portfolio, a stock portfolio, whatever portfolio. The portfolio has volatility in it if it's in stocks and bonds. We saw volatility in bonds last year quite a bit, as well as stocks. Everybody kind of accepts the volatility in stocks. But if I'm looking to just take a distribution of cash from my portfolio every year, and I'll sell when I need to sell, and if the market goes way up, I don't have to sell so much because I've got a lot of appreciation, and if the market goes down, I'll just sell more to get there. If you get 10 good years, 10 positive years to start, you're probably okay.
Maybe.
And that has happened.
Mm-hmm.
But if you get a couple of down years,
in the first few years,
in the first 5 to 10 years
of retirement,
they don't even have to be a 2008, 2009. They don't have to be a 2000, 2001, 2002 to screw it up. It can be, down 2, 3%, down 10%, down 2, 3%, and then have good years alongside of that. But if you're taking money out and selling in those down years, you have 2, 3, 4 down years in the first 10. You're probably going to have some issues with, basically depleting your portfolio before you deplete your time. That to me is a problem. And so some advisors will say, well, when the market's down, the 4% rule, it works. You reset it every year.
So when the market's down, just spend less?
Spend 4% of the value of the portfolio.
I would say advisors at Lucia aren't going to
We're not going to say that.
No.
Well, and I think that's a dumb thing to say because that presumes that I have flexibility in my bills. It also, and even the assets or the expenses that I do have flexibility, travel and things like that, I don't want the market telling me when I can and cannot go to travel, because if it goes down and I'm healthy enough to travel now, but unfortunately 5 or 6 years from now when it comes back, I may not be healthy enough or to go. Or maybe they've put I really want to see a certain area, but 5 years from now the State Department, whoever is saying, don't go there. It's not safe to go. I'm only saying that because I'm going somewhere in December for a destination wedding, not mine, obviously, but my nephew's destination wedding, and the State Department just issued a travel warning for that particular area. It's like, oh, come on.
Well, but you don't want the stock market to tell you what you can and cannot do.
You do not want to let the stock market, which you have no control over, tell you what you can and cannot do. So popular things to do with the 4% rule are just set 4% every year, or when the market's down, just don't spend any money until the market comes back. Well, that's stinky too. I don't want to do that, because now I'm giving the control of my finances over to something that I have no control over. And you have no control of the market.
Well, and I mean, my gosh, I couldn't sleep at night if I had to worry about where stocks are going this month.
And unfortunately, that creates an emotional reaction to things,
and you
where
panic.
you tend to not buy low, sell high. You tend to sell low because you panic and think, well, the market's going down. I got to get out before I lose everything. Yeah. And then you miss the recovery. I mean, you're already missing the recovery with the assets you spent.
Yeah.
But now you're going to miss the recovery with everything else that you put into cash to avoid the downturn. Well, you're avoiding the recovery as well.
This elevator's going down. I'm getting off on this floor. I can't take it anymore. So as soon as you get off on that floor, the elevator goes the other way.
Yeah.
You say, oh, I missed it. I got to wait till it comes back.
Or it goes down 2 more floors and you think, I'm a genius. And then it takes an express all the way to the roof.
And that's the problem. So as far as answering the question about how much of my portfolio should be in stocks when I retire, the it depends part, Professor Plum, is really how much do you need to take from your portfolio to cover your bills, to cover your expenses.
Right. A properly structured bucket strategy will tell you how much money you can afford to put into pure stock portfolios.
You start with the short-term stuff, right?
Right. You got to cover the needs I have, right away.
And is any of that done by guaranteed sources? Whether it's Social Security, pension, maybe an annuity if somebody wants that, whatever.
That to me depends on the style of the expenses that we're dealing with.
But we look at guaranteed sources, then we say how much does the portfolio need to provide? And
right.
from there, you back
the
in.
What's my shortfall? I've got these guaranteed income sources, Social Security, pensions, and others, but I need more, and the portfolio needs to provide my shortfall. So what's my shortfall? I need to then calculate out what's my shortfall this year, next year, projected out, and then back into how much money I need in safer areas. Yeah. Because if I need to spend X amount of dollars this year, next year, I don't want it in the stock market unless I'm just a gambler, and I'm willing to accept less, and I don't like that. Most retirees don't like that either, by the way.
All the studies show that they don't care as much about gains as they do not having losses.
Yeah.
Really, it's true.
I know people that say, look, I know that we're not going to get rich by doing it this way, but somehow structure this portfolio so that there are no losses. I'll take whatever the safe stuff will give me. I don't need to grow it to the moon. I just emotionally can't handle losses.
Well, have you seen people with entire portfolios that are just
treasuries, CDs,
treasuries, laddered
bonds,
and
yeah, I mean, and even the laddered bonds will have some fluctuation in values on a month-to-month basis.
Yeah.
But if you're buying individual bonds and you hold them to maturity, you know what you're getting.
Yeah.
Now, if interest rates go up or down, you're going to see some fluctuation in the current price. But that somebody can handle and say, oh, I know it's going to mature and it's going to be this. I know what I'm getting. But stock markets where you can see some, I don't like that negative number. Luckily, they're in a position where they don't have to have huge rates of return.
The emotional thing does play a role.
Oh, always.
And it is taken into consideration, as you just said, right?
It will always play a role. No matter how unemotional you think you are about money or investing, there is some emotion in there. Most people have more, but some people are pretty robotic about what they do. But there's always some emotion.
As much as you want to, cater to that, as you should cater to that for that's the risk tolerance. But as people say, the market's going down. I know I have all the income I need, but I've got to sell these stocks. They're down 20%. What do you say to somebody like that?
Well, hopefully we ferreted that out before we put the money into
Exactly.
stocks.
And that's one of the things that you do, right?
But sometimes people will say, "Look, I understand, I can handle a 20% downturn." But at 21, they start freaking out.
Yeah. It can happen. You don't know. I mean, you don't know until you're confronted with it how you're going to react. Well, this is wonderful stuff. This is just. I'm glad we continued this discussion. This is a good 2-part discussion here. If you need some more information on this stuff, you should talk to Professor Plum. Well, really, any of the Lucia Capital Group advisors. We said at the top of this broadcast that they work as a team, and
talking to them is talking to me.
Well, in many ways, it is. But as a team, this gives you the approach that you need. It's almost like an asset allocation model. This does this. This person does this. This person does this, and we all have our jobs.
Yep.
And that's how that works. Give them a call at Lucia Capital Group, 800-644-1150.
The advisor allocation?
It could very well be, yes. And that may be a good term we're going to do. Going to invent one here. 800-644-1150. Also go online, luciacap.com, LUCIACAP.com. All kinds of resources. You can also contact us if you have questions like this. We got both of these actually from listeners who had asked us a while back. But we got to it about how much you need to retire and how much should you own in stocks when you retire. LuciaCap.com. Also, subscribe to our podcast, Spotify, iTunes. Listen every single week. I can not guarantee, because I'm not allowed to, but I can reasonably assure you that you're going to learn something. How's that? As you listen. Professor Plum, thank you so much.
You're welcome.
All right. We will be back again with more next week for Professor Rick Plum, Certified Financial Planner Professional, CFP. I'm your podcast host, Johnny Dean. Thanks for listening. Talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. It is important to keep in mind that investments in fixed income products are subject to liquidity risk, interest rate risk, financial risk, inflation risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. A value averaging strategy does not guarantee a profit or protection from loss. The investor sets a target growth rate or amount on his or her asset base or portfolio each month and then adjusts the next month's contribution according to the relative gain or shortfall made on the original asset base. Since such an investment plan involves continual investment in securities, you must consider your willingness to continue purchasing during periods of high or low price levels. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties, and if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Rick Plum is a registered representative with, and security and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.